Okay, so we are now back from our lunch break, ready to start here with the guerrilla trading tactics. And so this chapter, this is going to be probably a bit more intense just in terms of absorbing the information. There's a lot of different rules that need to be considered, but I'm going to do my very best to make it as simple as possible because I do think it starts to become a little overwhelming, or it can be perceived as overwhelming. So as I said, I'm going to do my very best here to make it as simple as possible for you. And I think I'm confident I'll be able to achieve that. All right. So with that said, let's get into the guerrilla tactics, which really are a series of tactics that look to take advantage of opportunities between 1 to 3 days. Right? That's kind of the window of opportunity that we're looking to take advantage of. It can be as short as 1 day, but as long as 2 to 3 days. Okay? And this is something that you'll look to take advantage of a lot of times in sideways environments, not all the time. You can certainly apply these tactics regardless of what's going on, but in a lot of cases when you have sideways movement between support and resistance, this is when a lot of those patterns are going to start to materialize, and you'll see why that is as we go on through the material here within this chapter. So the first thing that we need to do is define a bullish 2020 bar. And it's simply defined as any wide range bar that has its open price near the low of that time period and the close near the high of that time period. And the reason we call it a 2020 bar is because as a general rule, the open should be in the lower 20% of that candle's range and the close should be in the upper 20%. Right? In other words, you have very little, if any, topping or bottoming tails. And these 2020 candles are going to be far more important when they occur after at least one prior bar up. Several bars would be even more significant. And again, you'll see why that is as we go on. But the bullish 2020 bar tells us that many traders and or investors have gotten long. So you can have these bars setting up in different places. Now, you could have a 2020 bar on a breakout, but that is igniting a move higher. We're not necessarily looking in the context of guerrilla patterns for the 2020 bar to be igniting anything. And what we want is the 2020 bar to be exhausting a move. Okay? The bearish 2020 bar is just the opposite. It is a bearish candle defined by a wide range bar that has its opening price near the high of that candle and the close near the low. And again, as a general rule, we call it a 2020 because it should be, the open should be in the upper 20% of that candle and the close should be in the lower 20% of that candle. Now, these bearish 2020 bars within the context of guerrilla tactics are going to be far more important when they occur after at least one prior down bar. But if you can get multiple bars down and then a 2020 bar, it's even better. It's more significant. So the first of 12 guerrilla tactics that we're going to talk about is the gap and snap play. So what we're going to do is first of all talk about the setup and what we're looking for. At a minimum, you want to have 2 fluid red bars down. And on the second day, or on the current day, you want to see a wide range bar being, you want to see that 2020 bar. Now, as a general rule, at least $1.50 for the average $30 stock. I mean, I wouldn't adhere too close to this, to be perfectly honest with you. I wouldn't get hung up on this because at the end of the day, you're looking for a 2020 bar. If you have a 2020 bar after 2 days or more being down, then you've got what you're looking for. That's the setup. Okay? So then, now that we've got the setup, what is the action? What we're looking for is the stock to gap down on the open by 50 cents or more. Okay, and then it begins to rally back. As it begins to rally back to the upside, we're going to look to enter long above the prior day's low. And a stop loss will then be placed below the current day's low. And we'll then look to sell this for a $2+ profit, or on the second day, whichever comes first. Right? So that's the gap and snap. Basically, you've got at least 2 days down, then a gap down, so things have become short-term climactic to the downside. If the stock can rally back up and reclaim yesterday's low, you're going to look to enter it long. All right? And then you look to hold it for a $2+ profit, multi-day run up into resistance. Okay. Most of these setups, most of these tactics that we're going to talk about here require 2 days either up or down depending on the direction of the trade. So, I mean, as far as the setup goes, for the most part, at a minimum, 2 days up or down, with the most recent day being a 2020 bar. And then, depending on where it's opening, is going to dictate which of the guerrilla tactics it is. And what I just said will become more clear as we move on through this material. And I will also make sure to reinforce that. All right, so that's your gap and snap. The counterpart to the gap and snap is the gap and crap, which here you have at least 2 fluid days up, with the most recent day being that wide range 2020 bar. All right, so if you have this here now in place, you're looking to say, okay, well, where does it open the following day? If it opens the following day with a gap up, as a general rule, 50 cents or more, you're going to look to enter this stock as it begins to fall back down. And if it breaks below the prior day's high, you are going to sell it short. All right, so that's where you're going to sell it short. Your stop is going to go slightly over the current day's high, and you're going to look for a $2+ move lower, or cover it on the second day, whichever comes first. You know, if it moves into support at a lower level, obviously look to cover it at that point as well. That would be your other option. So yeah, Facebook would be an example. Absolutely. You had Facebook moving up a couple days in a row. Thursday was a 2020 bar. It then gapped up the following day and then came back down. So yeah, you could have looked at that as a gap and crap. Well, it's really, these tactics are for daily time frames only because of the gaps. So that being said, you can use the concept, right? If you say, hey, this stock is gapping up and I believe that it's short-term climactic, you might look to sell it short off of a, breaking below the first 5-minute bar's low. You could consider doing that. But as far as these tactics, as we're talking about them right now, because they require a gap, it's specific to the daily time frame. Okay? That's a good question. Because you don't want to see gaps on your intraday charts. That would indicate that the stock is illiquid, that it's not getting enough volume to make it worth your time to trade it. Now, the next setup is a bullish gap surprise. So again, I mean, the setup is the same. You've got your at least two fluid days down, the most recent day being a 2020 bar. And here you also have above average volume. So, I mean, this is an added benefit. If you were to get the above average volume with the gap and snap or the gap and crap, that would be ideal. Okay. But again, as you can see, the setup itself is pretty much the same as the gap and snap. The difference is where it opens the following day. So here we have a gap up by at least 50 cents above the prior day's close. In this case, you will look to buy it above the first 5-minute high, right? So this goes back to your question, Fred, as far as how you're going to enter. Right? This one, you look to enter above the first 5-minute high, or if you want to be more aggressive, you can enter immediately. Now, once this trade triggers, your stop goes below the prior day's low. So you're not going to use the current day, you're going to use the prior day. Remember, again, we want to use, as a general rule, whichever is lower. And then we're looking for it to rally $2 to $3+ or selling it on the second day, whichever comes first. Right? But ultimately, at the end of the day, we're looking to sell it as it moves up into resistance. So you can look to buy this off of the first 5-minute high or immediately, expecting it to rally. Now, why would you be buying this on the gap up in this way? Remember, again, the fact that you've got at least 2 days down and the most recent day being a 2020 bar with above average or climactic volume tells you that the move lower has been exhausted, right? So that's why you're looking to take a more aggressive entry into this, because essentially you're looking at it as trying to get in on the turn of what will become a climactic buy setup, potentially, if you've got more than 2 days, right? If you've got at least 5 days down. So that's part of the logic there. The bearish counterpart is none other than the bearish gap surprise. So why is it a surprise, right? Why are we calling it a surprise in the first place? Because you've got at least 2 fluid days up, the most recent day being a bullish 2020 candle, indicating that the majority of traders have now committed to the long side. So when it gaps down the next day by at least 50 cents, those traders, at least some of them, are now losing. And if this continues to fall, more and more traders will have to cut those losses, which is what begins to create that waterfall move lower that we would be looking for. So we're going to look to sell this short, either below the first 5-minute bar's low, or more aggressively, immediately, right on the open. In any case, whatever you choose to do here, the stop will be slightly above the prior day's high, and then again, you're going to look to cover this for a $2+ profit in general, but also remember, ultimately what matters most is when it comes into either support, if shorting, or resistance, if going long. So now our next example is the bullish 2020 play, where we have the stock down at least 2 fluid days in a row. Again, that does not change. You've got the volume coming in. None of that changes. None of that changes. It's all the same in terms of the setup. Where it differs is in the open of the following day. So here, it opens neutral, right? The stock opens less than 50 cents to the upside. So in this case, what you're going to do is wait the first 30 minutes of the day to see who's taking control, the bulls or the bears. And then you set an entry above the high of that 30-minute candle, right? Above the 30-minute base, assuming it is in fact a base. Bottom line, you're going to look to buy above the high of the first 30 minutes of the day. If it triggers, your stop goes under either the low of the prior day or the low of the current day, whichever is lower, because it's possible the stock traded down off the open and then rallied back up. Okay, so then you'll look to sell this for a $2+ profit or on the second day. Is this the same as a pro gap? I'm pretty sure you're talking about the prior example, the bullish gap surprise or bearish gap surprise. It's not. A pro gap would basically require it to gap above the high of that bearish 2020 bar, right? Completely catching everybody in a negative position. That would be a pro gap. So again, that is a good question. So the bearish 2020 play. Again, we have at least two fluid green bars to the upside in a row, with the most recent bar being a 2020 candle and above average volume, which tells us again that the commitment is high. Traders have committed to this as a long. The next day, the stock opens less than 50 cents below the prior day's high. So you're going to wait the first 30 minutes of trading and then look to sell it short below the low established in those first 30 minutes. If it triggers, your stop then will be placed either above the high of the day or the prior day, whichever happens to be higher. And then you have your target set at a lower point somewhere down near support. The reason we're waiting the first 30 minutes is to see who's taking control, because this is a neutral open for the most part. So this could just start to rip higher and we could get another 2020 bar to the upside by the end of the day. Right? That's why we want to wait the first 30 minutes. It's not as bearish of a gap as the gap surprise, where that's gapping down 50 cents or more. This is less than 50 cents. So again, it's more neutral overall. The next tactic is the bull trap. And with the bull trap, it is a little different in terms of the overall setup, because the current bar, we're only looking at one here. It must be a 2020 bar. If it's followed, or rather preceded by multiple days having moved up, that's even better, but it's not necessarily required. So here's, again, the setup. And what we're looking for, what happens on the very next day, is that we open neutral and trade completely down, or maybe even we get a gap down and then trade below the low of the prior day, the bullish day. So this takes some time to unfold, but it is a bull trap that you can then look to short under the low of the bullish candle. And your stop will be above either the current day's high or the prior day's high, whichever is higher. Now, this could sometimes trigger as a sell setup too. I mean, you could have had a multi-day move up, and then this bull trap is what triggers a sell setup, right? So that could be the case. Now, what I want to bring your attention to is what's happening here at B and C, because not only is this a bull trap at B, but it could also be, if we had at least one other day up, a gap and crap, right? If this was gapping up 50 cents or more, this would also qualify as a gap and crap, where we could have entered short as it traded below the green bar's high. You guys see that? Right? You could have entered it short as it traded below there. as a gap and crap. Does that make sense? Yeah. Now, with C, this could have been your gap surprise, where you could have entered it right off the open as a short or waited the first 5 minutes and traded under that low. Same thing with D. So both C and D, right? Both C and D, what you have there is your bearish gap surprise. And even at A, you could call this a 2020 play, where it opens neutral and then you could short it under the low of the first 30 minutes. So the point is, maybe you miss the initial setup, but there is still another opportunity here as it completely engulfs and traps all of the bulls. All of those who were getting long are now caught, and they're going to be forced into covering those positions. The bear trap, tactic number 8, is just the opposite. So here you've got at least one bearish 2020 bar. It would be ideal if it's been preceded by a multi-day move down. That would be better. But the power of this setup is why we don't necessarily require it. So you get the bear trap as we trade above the high of the prior day. That triggers the entry long. Your stop goes under either the low of the current day or prior day, whichever is lower. And again, as we discussed in the prior example, you could look at this as a 2020 play at A as well, looking to enter above the first 30-minute high. You could look at B as a gap and snap, not just a bear trap. And at D, you have these bullish gap surprise plays. Okay, so it's not just one setup alone here that you could have considered entry based upon. Here we've got a couple different guerrilla tactics marked up on this chart just for you to see. And here you can, on the far left, see that you've got at least 2 days down, the second day being a 2020 bar. It's followed by a gap up, bullish gap surprise. So again, either an immediate entry or you could look to enter above the first 5-minute high. And then you're looking for a multi-bar move up into resistance where you'd be looking to take your profit. Over here, you've got your bearish 2020 play where it opens neutral, and after the first 30 minutes of the day, you see it's weakening, you see it's breaking down, you can look to short that after you've already recognized it's up multiple bars here, 2020 bar, things are getting a little extended or stretched, a little tired. So that sets up this pullback. Over here in the middle, you have a bearish gap surprise. 2 days up, bearish gap surprise, 5-minute low entry, down it comes. And then here's your, again, bearish 2020. Now, I do also want to point out, guys, that this is all happening within a pretty sideways trend overall. And that's where the guerrilla tactics will be more valuable, is when you have sideways volatility going on, and basically you're looking to play it between major support and major resistance. Here you've got your gap and snap. Multiple days down, wide range bar ending, novice volume, right? This is a climactic buy setup. However, we don't want to wait for it to trade all the way back up above this high, which, by the way, if we did, not only is it a climactic buy setup, it's also a bear trap, right, which we just talked about. So you could enter this as a bear trap, but you could also play it as a gap and snap where it gaps down, and then as it trades back up above the prior day's low, that's your signal to play it long. So you've got options here. You've got choices as to how you want to go about playing this. Aggressively, you can enter it as a gap and snap. If you want to wait for a little more information, play it as a bear trap. But either way, you'd be looking to play this long for a move back up into this $100 area. Another example, here we have a bullish gap surprise. Here, you've got at least 2 days down, big wide range 2020 bar, huge volume, novice in nature, ending the move, and by the way, right into support. So there's reason for buyers to step up here. Then what happens the next day? We get a gap up, right? We get a gap up here. So what kind of entry does this call for? An immediate entry or over the first 5-minute high, right? And then it does take a little bit of time, but hey, I mean, this is, this is a sub $10 stock. So it eventually works its way back up into this area here. And that's where you could be looking to take some profit, right? As it starts to work its way up, you start to see these topping tails. I'd be looking to take some profit up there. Or, look, maybe you would have just taken profit on day one. Because if you entered here right at or just above $7 and it ripped up to, call it, just under $9, I mean, come on, right? You would have taken it there probably. You wouldn't have held it the next couple days. I probably wouldn't have. So you could have taken that 5-minute high entry or immediate entry and just taken it on that day that you entered and not even hung around to see what happens. In most cases, it's also a PBS PSS with a 2020 candle. I wouldn't, sometimes, sometimes it's going to be a buy setup or sell setup at major support or resistance. Not always, but in some cases, it certainly will be. Or maybe it's even like we just looked at, a climactic setup, right? Which we see here again. Multiple days down, 2020 bar. It is climactic. You see the volume, right? So here it opens with a gap down. Now, can't really tell how much of a gap down it is, but maybe you'd look at this as either a 2020 play where you can wait the first 30 minutes and then buy it, or again, maybe depending on how much it gapped, it'd be a gap and snap where you'd buy it as it trades back up above the prior day's low, or treat it as a bear trap, right? I mean, again, you've got some choices here, and as you can see, it closes extremely bullish and continues to move on up into this prior resistance. And then if we fast forward to over here, we've got a bearish gap surprise igniting a move lower. After multiple days up, bullish 2020 bar, we gap down into that candle, trapping traders long. So you look to sell it short under the 5-minute low or immediately. And then your stop would go above the prior day's high. Or in some cases, when it's extremely large like that, I mean, if you're getting immediate follow through, look, initially it's got to be over the prior day's high just to factor in the volatility that may happen off the open. But then as it starts to move in your favor, you can bring it down to the current day's high. So the time frame we're using to identify the pattern itself is the daily. Then, depending on which of the guerrilla tactics it falls into, we could be using either a 5-minute chart or I wouldn't even necessarily use a 30-minute chart, but you can use the 5-minute to identify the 30-minute high and then enter if it trades above or below that level. Okay. Or don't stocks have huge spreads immediately after the open? Do you use market orders? There are stocks that will have larger spreads off the open, some not so much. So that is definitely something that needs to be considered and factored in. I wouldn't suggest using market orders, though. What I would say is if you find something that does have a bit of a spread to it, use a limit order to get in. And if you get skipped, if you don't get filled, or if you only get partially filled, then so be it. But I wouldn't use a market order because you don't want to be at the mercy of the market. Not if you don't have to be. The 1, 2, 3 continuation play. This is not just something that that you would look for on a daily chart. This could be played on intraday time frames as well. So this is the only guerrilla tactic that you can actually play on a 1 minute, a 2 minute, a 5 minute, etc. So the setup is bar number 1 has to be a wide range bullish 2020 bar igniting a move, right? That's the key here. This is igniting a move. It's not ending a move. Bar number 2 ideally stays within the top third of bar number 1 without trading above the high of bar number 1. Now, for me, I don't adhere to that rule in absolute. Meaning, if we trade a little bit above bar number 1's high, right? If we get a little bit of a topping tail or something like that, it's not the end of the world to me. Ideally, it stays below it, but if we get a little bit of a tail there, it doesn't negate the trade for me. Right? So this is, again, the setup. And as I said, this works well on any time frame that you trade from. So now the action is going to be to buy when we trade above the high of either bar number 1 or 2, whichever was higher, as that signifies a 2-bar breakout. The stop is going to be placed under the low of the inside bar, under the low of that bar number 2, right? Or sometimes it might be the trigger bar, depending on if it tried to move lower first and came back up. Basically, as we've continued to say here, whichever is lower. And then you're going to use your trailing stop. Because this is generally in the direction of the trend and in the direction of a move that is just getting ignited, you don't have to sell it for, the second day. You can manage it based on your trend rules, your trend management rules. So as it pushes on up into the next area of resistance, a multi-bar trail, whatever the case may be. Here you can see an example of a 1, 2, 3 continuation play. You've got your wide range bar igniting the move up. Inside bar, you buy the break over those highs, looking for continuation. Your stop goes under the low, and you get a beautiful move out of it. And now this wasn't the only opportunity on the chart, but that is the context of our discussion here right now as the 1, 2, 3 continuation play. Right? So again, wide range bar up, inside bar, play it over the highs, off it goes. This is a daily chart, but as I said, it doesn't matter what the time frame. You need volume igniting the bar. You don't necessarily need volume igniting the bar. It would be nice if you do, but it's not necessarily a requirement because I've seen times where, as you can see in this example, you don't really have a huge volume surge, but then as the stock continues to move higher in your favor, you do get that igniting type of volume. Question, okay? And where do you look at as the target? You'd have to look off to the left. We can't see anything on this time frame, but you'd have to be looking off to the left to identify, where the next area of either support or in this case resistance resides. All right, so here again, daily chart, 1, 2, 3 continuation. Here you do have that igniting volume with the wide range bar breaking out of a stage 1 consolidation. So here you get your inside bar and 1, 2, 3 continuation entry the following day. So you'd buy it again as it breaks over those highs. Your stop goes under the low of the bottoming tail. And then where do you set your target? I mean, looking at this, you could be looking at a target somewhere up in the $46 area because there's nothing else to stop it. I mean, it's got room to move up. Maybe, and quite frankly, I mean, I wouldn't be too concerned with this area right here because we've moved away from it over time. You know, here we are several months later. This to me is not as significant, which is why I say it could move deeper into this area, pushing up towards 46. Okay. But this was a really nice setup. And like I said, I mean, this is a daily chart, but honestly, you can see these types of things happening on intraday charts as well. Speaking of, here you have a 60-minute chart. Gaps up, wide range bar, clearing resistance. So stage 1 into transition A that should become a stage 2. Now it takes a couple extra bars here, so there are times where you might get an extra bar of stabilization, in which case we might just call it a 1, 2, 3, 4 continuation play. Entry is still the same. You're going to buy it as it trades over the high of those candles. Okay. Now, this obviously begs the question, well, what if you get another candle going sideways? Do you then call it a 1, 2, 3, 4, 5? And if so, where does that stop? So no, you don't call it a 1, 2, 3, 4, 5. At that point, if you get another bar of consolidation, it's becoming a pause that refreshes. At which point you're just still looking to buy it above the top of the range, but you're not going to call it a continuation play. Instead, like I said, it's going to be viewed as a pause that refreshes. Okay. So now here we've got another chart, intraday. Gap up off the open. First candle here closes with a wide range bar. You get an inside bar following it. 1, 2, 3 continuation. Buy it over the high. Stop under the low. Really tight. Stop there. And then boom, off it goes. Okay, so this was a nice intraday continuation. And I'll tell you what, this isn't going to follow through in the way that it does unless the larger time frame is also bullish. Right, so you can pretty much guarantee the larger time frame here was in agreement with this intraday chart. The next example here is your bearish 1, 2, 3 continuation. So everything that we just talked about, now reverse it. You've got a wide range bar down, igniting a move, followed by bar number 2, which ideally stays inside of bar number 1's range, but doesn't have to. Like I said, if it tries to dip a little lower, comes back up, that's not the end of the world, because I've seen those patterns work out exactly as you would want to see them anyway. So you're going to short it as it breaks down below the low of either the inside bar or the wide range bar, whichever is lower. Are there differences for expectations in terms of target relative to time frame? Yeah, that's just, I mean, you're not going to expect the same kind of target necessarily because, like you said, 5-minute isn't going to be trading in as wide of a range as, say, a daily chart. So by default, that is true. The expectations will be different, but the approach is no different, right? It's all relative. On a 5-minute chart, you're still going to look to where's the next level of either support or resistance. So the approach doesn't change, but right, since the time frame is smaller, you're not going to make as much necessarily trading off of a 5-minute as you would off of a daily. All right, so here you've got your bearish 1, 2, 3 continuation setup, breaking down with a wide range bar from a sideways stage 3. You've got the volume coming in as well, inside bar. So what are you looking to do? You're going to look to sell it short under these lows. Your stop will go over the highs. And then as far as a target goes, where are you going to look? Now, I personally would be looking for it to come down into the $23 area in that level, not necessarily down in here, because the wide range bar is igniting a new move. My expectation is that that first level right here is going to be exceeded. Okay. Last slide. Let's go here. I saw use trailing stop. How do you calculate that based on the price of the stock? I wouldn't use the price of the stock to calculate your trailing method. I would use whatever is comfortable for you, bar by bar. So as each new bar forms in the move down, bring your stop to just above that bar's high. If you want to use pivots, you could use price pivots. You know, some people choose to use a moving average, but I wouldn't try and calculate a percentage trail stop based on the price of the stock. You don't necessarily need downward sloping moving averages to enter in any of these, because sometimes they're taking advantage of sideways environments. And like we just looked at here, the moving averages are beginning to slope down. But remember, moving averages, they're basically magnetized by price. So whatever price is doing, price moving up or down is what's going to pull the moving averages. So in order for these moving averages to begin sloping down, you're going to have to see additional follow through lower, at which point it would be too late. So no, you don't necessarily need the moving averages to be sloping downward to enter shorts or up to enter longs within the context of these patterns, or even transitions for that matter. Here we've got another bearish 1, 2, 3, 4 breakdown, wide range bar, igniting the move with volume. You get your couple bars of consolidation, topping tails telling us that the supply is increasing. You look to short the breakdown here, right? Short the breakdown under these lows, and then boom, down it goes. And not only that, but as it begins to fall, it goes climactic. You could have looked to then reverse. You could have looked to cover your short and then get long based on the climactic buy setup. The next guerrilla tactic is the bearish mortgage play, or what some have already alluded to or questioned, in another way of looking at it, is a professional gap. What happens here is you've got at least one bar, 20-20 bar, that indicates a large number of longs have committed, and then bar number 2 opens below the low of bar number 1. Right? So it's a complete gap down below that bar's entire range. Now, I will say that with this, the stop is going to be big. However, there are times where the gaps can be so large that it just makes no sense to use the initial stop that's suggested, and we may just have to adjust that based on one scenario to another. But basically what you're looking to do is buy it immediately, or in this case, short it immediately off the open because of the shock that's taking place. And your stop will go over the high of the prior day. So like I said, it is a bigger stop, but there's no other reference point to use at this point right now. And the likelihood of this stock reversing and going all the way back up is extremely low, especially if it's got room to continue falling to the downside. The bullish mortgage play is just the opposite. So here you've got a bearish 2020 bar, indicating a large number of traders have gotten short or sold out of positions. And then bar number 2 opens above the high of bar number 1, completely trapping any and all shorts. So what are they going to do upon the open? They're going to look to cover. They're going to be buying a cover. Therefore, you're going to look to buy it immediately off the open. And again, the stop here will be initially below the low of the prior candle, unless you can find some other place to put it. I mean, if you can find a better place off of, say, an hourly chart, then you can certainly do that. You can certainly use that. But you want to be careful not to go too tight initially so that you allow the trade room to start moving in your favor. Now, because of the larger stop, you're also, as a result, going to be taking fewer shares so as to not be risking more than what you plan to risk per trade. Right? So while the stop is larger, it does not mean you're risking any more. You're just not taking as many shares. So here is an example of a bullish mortgage play or professional gap. Now, obviously, I'm not going to suggest that you enter this right at the open and put your stop down below the prior day's low. That would just be insane. Okay? So, what do you do in a situation like this? Well, where is the first level of support, right? Because now we're gapping up, right? Now we're gapping up. So where might you put your stop? Yeah, 1950 could be a spot. Absolutely. Yeah, exactly. You look to the left. So here you can see you've got, right, around this 1950 level, you've got some support. So at or even just below 1950 would be a good spot to have your stop. Or if you want to give it a little bit lower, you could do that too. The choice is yours. But yes, you look to the left, you find where those reference points are, and that's what you use to determine where your stop is initially going to be. That is exactly right. And then you just manage the position up based on where you believe it can go, what the targets are telling you, what the larger time frame's telling you. But this is a professional gap as it's changing the direction of the trend. Right? This is something that is very unlikely to come back in and resume the weakness that it was showing prior to the gap. This is, again, something that when it's opening like this, you buy it immediately off the open. Here you can also see another, now, well, not another, but this is the opposite, the bearish mortgage play, where you have this wide range bar up, and it gaps down not just below the low of the wide range bar, but it's also gapping down under this support and also this support over here, right? So here's the first level, and then here's your second level right there that it's gapping just below. So you short it on the open, and your stop, I mean, look, your stop here, if you don't want to put it above 17, you could put it above 16 because really that's where you've got some resistance. If it comes back and fills the gap, I would expect it rolls over from that point. So maybe you want to use just above 16 as your stop. But either way, you're entering it right off the open, and boom, down price goes. All right, so now here we have a little bit of multiple time frame agreement, or using a smaller time frame to enter into what the larger time frame is telling us. And so looking at this example here, you've got a gap up. I'm not crazy about it as a gap up. I mean, look, it is gapping above 3 days worth of consolidation. So to that degree, it is bullish and it's within an uptrend. So there are reasons to like what's happening here. It was going sideways a couple days. The last day prior to the gap up closed on the low, suggesting that traders were committed to the short side, right? And then it gaps up above all that stuff. So there was definitely reason to be bullish on this. And so looking at what the 2-minute did at the time, you can see that it just starts to go sideways. You could have entered off the open, right? You could have entered it off the open, or as it consolidates on the 2-minute, you could play the breakout. Either the first one or the second one. You could play those breakouts as alternate ways to get on board. You know, what I would suggest doing is looking to enter above the 1-minute bars high. As far as entering off the open, I would at least let the first minute or two of trading transpire and get involved over that high. This way it gives you at least a reference point to use. Okay. Now here's a bearish mortgage play. What I want to point out is the power of this message, the power of these professional gaps, because there was a good bit of support off to the left here. But as you can see, we closed deeply into and through most of that support. Okay, so gapping down below this consolidation sets the tone for the day. And if you did short it immediately off the open or under the first 1-minute bars low, whatever the case may be, you may or may not have been filled, right? And the reason I say that is because of this topping tail, or this tail that we got, right? So if you shorted it right at the open, you would have obviously gotten filled on that. However, if you waited for the 1 or the 2-minute low, it didn't trigger you right away, because if we look at the 2-minute, we see you had this retracement back up into the gap fill and pristine sell setup that formed first. So that was a really nice entry. After the gap down, you see how it retraced back up, gave you the sell setup, and then started to move lower. And so that, like I said, was really nice. If you did enter right off the open, this is why you need to be putting your stop up at higher levels, so that if it does try and rally up into the gap fill, you're not getting caught in that retracement. Here we can see a number of different opportunities, whether it be a breakout, a PBS, a climactic sell setup, or a professional gap / mortgage play. Marking up charts in this way will help speed up the learning curve. In fact, what I would also suggest you do is not just mark it up with, PBS, climactic sell setup, what have you, but also what are the amplifiers that go along with it, as that will help to reinforce looking for those cues as well. Okay, so here we've got a number of different pristine opportunities marked up by each of these numbers. At 1, you've got a climactic buy setup. Multiple bars down, reversal, climactic buy setup. At 2, this is a failed PSS, a failed pristine sell setup. Why did it fail in the first place? Because it was following a climactic buy setup. As we discussed in the climactic chapter, the first sell setup following a climactic buy setup is likely to fail. Okay? So that is why we wouldn't have been looking to play it in the first place. However, at 3, we get this topping tail. All right? this topping tail here strongly reinforces the idea that sellers are still very aggressive here and that we'd be looking for price to move lower. So we'd be looking to sell it short under that topping tail and expecting a move back down. Right, and it's also the end of the month. Good catch. Exactly. So not only do you have the retracement, the topping tail, 40 to 60%, minor resistance, bearish changing of guard, etc. But as Miles said, you also have the end of the month reversal time. Oops. Then at 4, as price continues to move lower, right? At 4, you have a climactic buy setup that's also a gap and snap. And with the gap and snap, what you'd be looking to do is enter it as it trades back up above the prior day's low.